This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, we've packed a number of shows together to give you some highlights. I know you're going to enjoy the show. Thank you for being with us today. Our guest is Sam Giordano. Sam, welcome to the show. What turned you off about a specific operator versus, making you ask more questions or want to eventually partner with someone?
Sure. No, makes sense. Well, the great thing about it is often the sponsors that endear me the most, it's hard for them to do anything about that. They either have it or they don't. Meaning, like, you have to get a feel that somebody actually cares about what you're talking about, as opposed to they're just focused on selling you something. And it's almost as if, like, not to talk bad about car salesmen or anything like that, or people who call you telemarketers, but there's some people you just get the feel they're really trying to sell you something and they're not really interested in you at all, and trying to see, is there a fit here? Is there a relationship here? And people ask me, whether it's in the business realm or physician realm, the similar types of questions, because this kind of skirts across all fields, but it's almost like you can't fake it. So I think the biggest thing I would say for sponsors to try to help with that is to really focus on what I can do to show that I really care about the investor as a person, and what can I can do to provide value, as opposed to focus on how do I get this investor to sign up for my deal. And it's a mindset thing that some people can or can't do. So from that standpoint, but I think the biggest negative is there are some sponsors that I spoke to, and right after the conversation, I'm like, I'm running the other way. Like, there's no way I want to invest in this sponsor's deal. And it was really, I just felt dirtier after the conversation, and I just felt like I was really being sold something. And that, to me, I mean, it's just maybe me personally, but it just kind of turns me off a little bit, as opposed
Did
to
they like try to just jump into a deal, or jump into trying to get you to invest right away? Or, what was it that they said? Or is there anything that you could highlight there that's like, man, they just handled this so poorly, or I felt this way because they did this?
Yeah, so some of it was, generally when you start a conversation with a sponsor, they ask a little bit about you. And some people, while you're doing that, they let you go. And then some people kind of interrupt you throughout the process and bring up things about their organization before you even had a chance to kind of give some background on yourself. So they're really not listening. They're just waiting for opportunities to say something to you. And it's always in all conversations, it's always harder to be a listener, but I look for that, people who are good listeners in that process, because I think that generally shows confidence and comfort in what they're doing, and they're not as on edge on that. So I would say trying to interrupt you when you're talking initially, to kind of give a little background on yourself. And then they quickly veer towards what they would do by you investing in their syndication. And it's not as much about seeing if there's a true fit there.
I'm listening. I'm kidding. No, that's awesome. I feel like that's such a good example, Sam. I got like 2 calls yesterday. One of them, as soon as I answer the phone, they say, "Did you know your car warranty is about to expire?" That's what it made me think of. It's like, well, yeah. What? Who is this?
And that's kind of the way you feel.
I'm like, nope, thank you. Block that number, right? And so, yeah, we don't want to be that way as operators, for sure. I just think that's a great example of just how important that conversation is. And what about, and here's a thought, because this is something I've had to do personally, is like, as we have more and more investors that are, wanting to talk to us, right, or work with us, like, we want to have those conversations with them. I would love to speak to every one of them individually, but guess what? I can't. I have to groom someone on the team to do that, right? And it's
sure.
I waited as long as I possibly could to do that, because it's like, I want to have those conversations. I like those conversations and getting to know the investors. However, it's just not possible for me to do them all, right? So how do you feel about, hey, when you schedule a call or you finally get to talk to the team and you're having to talk, you're not getting to talk to the main operator? What are your thoughts around that as a passive investor? I wonder that personally, and I know many other operators that are listening wonder the same thing. How is that viewed as a potential LP, or passive investor, when, well, I didn't get to talk to the main operator, but, I got to talk to such and such on the team?
Yeah. And there were a couple operators that was the case. And one of them I did invest with. So it's definitely not a red flag for me. I think I think if there's a way to convey, I mean, and most passive investors, especially if they've got, looked into it and got some education, they realize there are certain groups of syndication teams that are just large enough to the point where it's just not logistically possible to talk to every new investor. I think if there's a way to sort of have that sort of investor relations person reiterate that, if you wanted to, or if there's additional questions that I can't answer, then you could have access to Whitney, to where it's as if there's a possibility, and you may get, a third of, maybe 10-15% of investors that take that. It's like when you give your cell phone out to somebody, like most people handle it like, like a patient or something like that. Most people handle it pretty well and don't abuse it, but there are some people that will, but it's not the majority. So I think if you offered something like that, where the investor relations person that is the one communicating that first sort of communication says, you know what, if I can't answer anything, you have the ability to reach out to Whitney himself, but he just can't speak with every investor, but we can certainly make that happen if that's the case, to where they feel like that you're not trying not to speak with them, but it's just there's logistics involved. I think something like that may be able to offset it. But like I said, there was one sponsorship team that I spoke to the investor relations person multiple times. They were very good. I was satisfied with the talk, and I never spoke with the actual sort of head sponsor of that team, and I invested with them anyway.
What if that person can't answer all your questions? So I know you mentioned like, there's an option for you to talk to the operator. However, maybe this person is not extremely knowledgeable even about the syndication business. Is that going to turn you off completely?
Maybe a little bit, only because that person, if they're in the investor relations position, they should really have the ability to answer most. I mean, most of the questions I asked aren't, I mean, they may be slightly more detailed than other limited partners, but they're not coming out of left field. I mean, at least I hope they're not, but so they really should be able to answer most of those questions, like, how many full cycle deals, information about the market, what's the business plan, what's the, some of these things I can get from the investment summary, but some of the things it's nice to have a conversation, especially when you first meet a sponsor. Like if I've invested 2-3 times in this group, it's not, I already know the group. I know what their communication is. It's really that first communication that you want that investor relations person to be prepared, because that's sort of just like anything. It's a reflection of the team, and if they seem unprepared, or then it may reflect badly on the team, because that's the only contact you have.
Yes, could not agree more. Now, I'm grateful just for you diving in on that, because I feel like it's a great subject for operators to think about, right? And I know I've struggled with that, because I want to take those calls, but it is just not possible to take them all, and so, which is a great problem. However, there's other issues that come up because of that, right? And so, and I know that there's so many things we could get into about the deal and the market and whatnot. And unfortunately, we're running low on time as far as doing all of that. But I feel like the operator is like the first link in, the due diligence, right, of investing, as an LP or passive investor. And so I'm just thankful to dive in. Anything else around, before we have to move to some other questions, Sam, anything else around, say, the operator specifically, that as an LP are like do's and don'ts, or, hey, if you see this, let's, stay away, or anything else you want to share just around the operator specifically when you're as an LP?
Yeah. So some of the objective criteria, like the biggest thing is the feel you get, that I can't emphasize that enough, because it's really important, and you have to trust your intuition. And whether it's in this field or any field, oftentimes your intuition is correct, and it's just a matter of supporting that feeling with the objective information. And that's kind of how I feel about the operator as well. Like the biggest thing is the intuition. And then after that, I generally look for operators or teams that have at least 5 full cycle deals at their experience, from an experience standpoint. I'm just not looking for home runs. I'm not looking to take excessive risk. I'm looking at the long game as a passive investor, and I want people who have done this before. So I look at that sort of people who have had 5 full cycle deals. It used to be that we had a criteria that if somebody has been in a real estate syndicator prior to 2008, which was the last like main recession, but as we get further and further along from that, there's just not that many syndicators that have that much experience. Now, most of the people that have are into sort of the private equity space, and they're not sort of dealing with limited, the limited partners and individual investors and stuff like that as much. So I don't use that criteria as much, but I would say the 5 full cycle deals, the geographic market, is it something that I'm interested in, that where they're focused on? Is this a new sort of investment in a different market? Like if somebody had deals, all their deals are in Texas and now they're going to Florida, or I don't generally like to invest in that first deal out just because of the fact that they need to kind of get their feet wet. And I'm not really interested in being part of that when that happens. I mean, it may be a great deal, but it's just not worth the risk to me,
Mm-hmm.
And then is there a succession plan if God forbid something happened to the sponsor? Is the deal going to implode, or is somebody there to kind of take over that? Those are some of the variables. There's there's others, but those are some of the big ones that we look at. Whether or not they accept what's the percentage that they accept from self-directed IRAs versus taxable investing, as somebody who invests post-tax money or taxable money. If a majority of the investors are self-directed IRAs or pre-tax money, then they may not be as interested in the tax benefits. Whereas someone like me who is, I want to see at least 50% or more of the investors that are investing cash or taxable money. And these may vary from a deal to deal basis, but some sponsors have more of a focus on certain types of investors and things like that. So those are some of them.
Yeah, that's great. That's just great insight for sure. And we could talk about this all day long, I know. But I want to ask just a few other things, because I love your perspective, from the LP side, and just as much as you've educated yourself, I just it's great. And so what about you're talking to an operator, like what do you like to see as far as them being prepared for a potential downturn?
Yeah. So, I mean, one of the biggest questions, like one of my sort of classic questions that I'll ask an operator, there's 2 usually. And one is, what makes you different? Because I find that it gets to the heart of sort of what they identify with and what their business plan is that may be different from others, or why they have a competitive advantage in the space. So it's sort of a broad question, but it gives the operator a chance to sort of, that gives me a feel for really where they feel like their identity is that separates them. And the second is, tell me about a deal that's gone bad. So I don't even ask them if a deal has gone bad. I say, tell me about a deal that's gone bad, because I just assume that there's something that's gone bad. So if they said there's no deal that's gone bad, then either they don't have enough experience, or because there's always something that comes up. Even if the deal winds up good, like you can talk about, a storm or a fire or something that happened that you had to kind of think on your feet. So I like to see how the operator responds to that deal. And then the follow-up to that question is, how do you mitigate that risk going forward? Or how, I don't ask them specifically how do they prepare for a downturn, but I just want to see what their preparation is, what they've learned from that experience, and what they've done to correct it, to give me an idea into the mindset of how much foresight they're looking for to prevent that kind of thing in the future.
Bronson, welcome back to the show for another day. I'm grateful for the listeners as well who are with us, and I hope that you will go back and listen to the last 2 days with Bronson. We've talked about many different topics, and even his path into multifamily success, which took many different pivots that he probably didn't expect, but I think it does for all of us. Our paths take many different pivots, but he was willing to step out and leave a what most would say a very successful job to take a chance on himself. And thankfully he did that. But then even yesterday, we talked about just the economic climate and different ways that he is funding his deals, even when the appetite investors are softening, and about why he still believes in multifamily, and why I do as well. But Bronson, welcome back to the show.
Awesome. Great to be back, man. I feel like I'm becoming a regular here, and maybe let's just talk every day. This is,
yeah,
this is great, man. Thanks for having me back.
Yeah, I'm honored to have you back. Oh, let's jump in. I know you dove into this investing business and real estate, and it's everything that's happening in the economy right now, which we talked about yesterday quite a bit. But how are you evaluating syndication deals right now? Just in your opinion, or maybe even how you guide passives to evaluate a syndication. Maybe you can talk at a high level, but then also let's dial it into today, right? To this current economic climate, if there's any changes there in your opinion.
Yeah, so that's a big couple questions there. So first of all, when it comes to evaluating
just thought
deals,
I'd start off real easy today.
Yeah. You just start with like drop the bomb. Here you go, mic drop, take it over. So yeah, I think when you're looking at deals, there's really 3 parts I encourage people to look at as passive investors. Is you have the market. So that's kind of the biggest thing. What market are you buying in? Then you have the operating group that you're working with, and then you have the specific deal that you're considering investing in. So I want to take each one of those, kind of how they look. So if you buy in the right market, and it's a growing market where you have population growth, job growth, income growth, you can do a lot of things wrong in the management of that property and still do phenomenally well. And why is that? It's because what the rising tide will raise all ships, right? So if you're buying in an area, if you're buying, let's say, not picking up people in Cleveland, but in Cleveland, population is flat or declining, right? So that you don't have population growth, job growth, income growth. Maybe you have other forms of growth, and people might send me angry emails that, okay, actually can do things there, but it's a different type of market, right? Versus where we buy in Jacksonville, Florida, we see 20,000 new people moving to Jacksonville every single month, right? There's a 97% occupancy in the city. So we see this market that's growing. We've got jobs. We've got people that are moving because of COVID. They can work remotely. We've got people that are retiring that want to live in Florida and pay no state income tax. You've got all these things that are here that are causing growth. So if you just have people moving there, you've got more jobs there, you have more income there. That's a great, great place to be. Second thing is the operator you're working with. Now, if it's somebody's first deal and there's nobody on the team that has more than 5 or 10 years of experience, you might want to say, well, I don't know this, how solid is it that they're going to be able to achieve this business plan, right? Because you want to make sure that all three of those things line up, right? The market, the team, and then the deal. So when it comes to the team, I look for, what's their reputation in the industry. How you figure that out is by going to events, by asking around, by a lot of just, maybe even searching online, trying to figure out, maybe talking with other investors that have invested with them. And you try to figure out, what are their core values? And I think a great question to ask operators is, what's something that didn't go according to plan? And how did you deal with that? And if anybody does not have an answer for that, I would say do not invest with that group, right? Because all these deals, they don't go as planned. They go in certain areas better than expected. They go about as expected. And others, oh, this went worse here. And there's so much learning that happens. Even people that I know, one of my partners has had 28 years of experience and 13,000 units, right? So my inexperience is not a big deal because he's got so much experience with the asset management. So that's the second thing, is just really making sure you got an experienced team where the values line up, the goals line up, the time horizon. You ask them, if this deal doesn't go well, what are the things that you see are the risk here? So when you're looking specifically at the deal, what I would say is, does it meet your investment goals? Is it the time horizon right? Is it achievable in the sense this group has done other deals and they have some track record to show that they could do something similar? Does the business plan make sense? Again, I quote Warren Buffett a lot. He says, we never invest in anything that we don't understand, right? So if it doesn't make sense to you, then don't invest with it. So I think that's a lot of things. And I think some people get stuck at this point because they look at like 5 or 10 deals and they can't figure out what to do. But my thought is just look at 5 deals and then choose one and invest with it. It'll probably go fine. And then you'll learn along the way, right? Regardless. So that's just kind of from a high level.
Yeah, no, I love too how, and many of those things we talk about, as far as evaluating, a new investment for a passive investor. But one thing I love that you brought up there is alignment of goals and values. Because I know operators personally that, they've produced amazing returns for a long time for investors. And I invest passively in numerous projects and other operators as well. Okay. But my whole point is, I know some operators who maybe they have this amazing track record, but I just personally wouldn't invest with them because our values would not align. And it almost goes back to another segment, you and I were talking about, just about how tenants are treated and how we care about our communities and those things. Right. And so I want our values to align. I want to make sure that, hey, I'm investing in a business that we would have the same or alignment of goals, right, and values and caring about these people. And so I just love that you brought that up. And I feel like the operators crucially important long before the deal, right? Long before you ask any questions about the deal. Any thoughts around just the current economic climate and investing passively, or any change of where you would put your focus as far as evaluating? Let's say all the operators are created equal. What would be the next thing as far as the current economic climate that you would focus on?
Yeah, so we talked a little bit about this yesterday, just about why I think it's a great time to invest in multifamily, just because of interest rates being higher. I think is actually a benefit in some ways to be able to readjust later to lower rates, which will cause valuations to rise. But I continue to, and again, this is not a popular view. And again, I'm not even sure, maybe this is your business models. I don't mean to be, if I say something that, is different than where you're at. But when it comes to Class A apartments that are brand new, I personally think that it's a higher risk type of proposition right now, because I think when you have a Class A apartment, you're assuming rents are going to continue to rise, right? There's no value to add, right? So if you're buying a brand new or a new construction or a new build, there's some risk there that, like in Pasadena, California, where I live, rents are $4,200 a month for a 2-bedroom. Well, if there's a serious recession, they're not going to get 4,200. They might get 3,500. They might get 3,000. It's the people that are in Class A apartments. Those people move down to Class B or they move down to Class C, right? They change or they move down. And so, but when you have a value add component, which just simply means you're going in, you're doing renovations, you're doing landscaping, you're doing stuff on the exterior, you're doing individual unit stuff, it gives you this margin of safety that really there's a bump in the value because it's different than single family. Single family is based on what did this comp property across the street or across town sell for, right? Multifamily is based on the income, how much income is actually coming in from the property. So it's a different way we calculate valuations, right? So if we can increase the rents or increase the other income from laundry or from parking or other things like that, we're dramatically increasing the value of that property. So I think that when you have a value add component, it puts a huge margin of safety in a deal versus something where there is no value to add.
Yeah. What about any specific strategies maybe you've used to protect investors from these market swings?
Yeah, so I think really kind of what you mentioned as well, I can't remember was this today or yesterday, but the idea of just being very conservative on your underwriting. This is a term that people use a lot. It's a core value of ours, but I think what it really comes into, there are a couple numbers. One is your rent growth assumptions, right? You can take any deal that's a terrible deal and make it look great if you just have huge rent growth, right? So we typically, even in booming markets, we typically never go above about 3% projected rent growth, even though rents are growing in certain markets that we're in by 20% or more, right? So being very modest there. Also, the cap rate at exit. So cap rate is just a value, how much you're paying for how much income you're getting. And as cap rates are, some people project that, oh, cap rates are going to keep going down. Well, you need to project that they're going to go higher, which would be less favorable when you sell, but just to be prepared for that, right? So our goal is to be modest on our projections and hopefully achieve them or outperform them. And I think it comes down to really investor expectations. But I think those are a couple of things just on being conservative side.
Yeah, no, that's great. Is there any specific opportunity that you could use as an example, maybe to talk through even some of the conservativeness on rent growth or exit caps? It doesn't even have to be your deal, or maybe somebody else's, or something you've thought about investing in, maybe you didn't because they had these assumptions.
Yeah. So I think it comes back to just the idea of really understanding the deal. Like, what is the biggest risk in the deal? And every deal, and again, more than real estate, we do real estate related stuff, but we talk about other assets like our ATM machine fund. We do, I do things in the precious metal space or the energy space. So whatever deal you're looking at, you always want to think about what is the downside, what are the risks there. So I think of some risks are being, the problem is if your projections are too lofty, it's really hard to see, are you going to be able to get that upside? And I've seen, there was a deal I looked at recently. I think there's being somebody who gets involved in deals. People want you to come and be a part of their deal and raise money or be a part of the management team. And somebody had a deal, I think it was like a 2012 build or something. So it was built more recently. They called it an A- value add. I'm thinking, well, it's only 10 years old. Like, how much value really could you add to this, right? But there are ways to add value. I'm not saying it's wrong. It's just, to me, it's just not something that I've done, focused on kind of the newer value add stuff as well. But I think, I've seen deals where people, their assumptions are just that everything's going to go perfect. From day one, we're going to be able to increase rents. We're going to have all these things, or even operators are communicating that, yeah, we're going to start giving distributions really early or really consistently. And it's like, some of it just has to depend on how the deal performs, right? But I don't know. I mean, I think it's more of a feel that I get when I read it. That's the challenge. Or when I look at a deal, is it's not just one thing. It's like, when I really look at it, I want to think, do I feel like I have a sense of where this operating group is coming from? Are they looking at the downsides? Do they have anything in there that says, hey, if this doesn't go well, here's what we get? Or maybe there's a sensitivity analysis that, okay, if rates are here, or if our cap rates are in this area, this is what we'll get paid, or and it just gives more options, right? So you're looking at it and you feel like at least the operator has a plan for if the tide turns and things go the other way. Because the longer you do this, Whitney, as you know, the more you realize there are things you can control and there are things that you cannot control. And you can control a fair number of things, but a lot of things you cannot control. So it's really how you manage those things before you get into a deal that's really, really important.
That's when you can make changes, right? Before you get into the deal.
Exactly. That's it.
Yeah. I appreciate you bringing that up. Yeah. That's when it's important that you think through as many possibilities as possible, right? And knowing that you're not going to know them all, right? You're not.
It's like getting married, right? Like the time to due diligence is before you get married, right? It's like once you're married, you're like, oh, you're married. It's like
Yeah.
you want to make sure that you've really taken a good look at everything and that it makes sense.
That's right. That's right.
That's dating advice there too for those.
Maybe you need a reserve budget before getting married. Right?
Yeah, exactly. Yeah, right. Contingency budget.
As far as even something like that, like a reserve budget or anything around that you like to see, or maybe that you're doing personally right now, how do you see those things so you're prepared for the downturn when it happens, or worst case scenario, or the unexpected? What are some things that you're important to you to have in place?
Yeah. So, I mean, yeah, contingency is huge. How much per door? Is it $250 per door per year? How much is it that you want to have in place? You want to have contingencies in place for, okay, these expenses cost more, these renovations cost more, it took longer than you thought. You're not able to get the income in the time frame that you thought. And so just that you have a plan and then you think through, like I get this question sometimes, well, you guys ever do a capital call? And like, no, we haven't done a capital call. And I'm grateful. But I say there's 5 things we'll do before we'll get to a capital. I have a plan for this, right? So we'll take out, hopefully we'll be more conservative on underwriting. We'll have extra reserves. So I can remember all 5 now that I'm on the spot here. If we had something really difficult, we could withhold distributions for a little bit saying, hey, we have this expense, we've got to do this. Hopefully insurance could potentially cover something if there was something catastrophic that happened. We could make a personal loan from the general partners to the property if we needed to. Then the last thing we would do is a capital call, right? Is a voluntary capital call. So those are things that what happens, and that's a great question too as a passive investor is what are the things in place? Have you ever had to do a capital call? Well, what are some things in place that would try to prevent that, right? A capital call is just, hey, we need more money. We ran out of money, right? And that's kind of like in any business, you never want to run out of money. So if there's plans in place that you have enough money or well enough capitalized, and it is a balance because if you have too much money, then your returns are lower than they should be, right? Because you raised too much money. And if they're too low, well, then you're going to feel it in the returns or you're going to be pinched on cash flow or operations. Neither is good. But I think if you're going to go one side or the other, have a little bit more money than you need.
Thank you for being with us again today. I hope that you have learned a lot from the show. Don't forget to like and subscribe. I hope you're telling your friends about the Real Estate Syndication Show and how they can also build wealth in real estate. You can also go to lifebridgecapital.com and start investing today.